Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 9 of my 10-part video series on tax planning for the year-end 2024. As mentioned in video number 1, starting January the 15th, 2025 and running through April the 15th, 2025, I will be hosting a 2024 tax return preparation class. There's no better way to learn tax planning than from inside the tax return. So this is where all the action is going to be with me and the channel for the 2025 tax busy season. There's an all new video FAQ on the class and the link to that can be found in the description below this video. Alright, in this particular video number 9, we're going to summarize the Roth IRA conversion decision-making process and prepare you to finalize your 2024 tax planning. There will be a 10th video in this series. However, it's going to be forward-looking in nature. The reason I bring that up is so you are not waiting on the 10th video to finalize your 2024 planning. You have all the information and guidance you need from this series in order to download the personal tax planning template, lay out your numbers for 2024 and your projections for future years, and finalize your 2024 tax planning decisions. And we're going to summarize that information and guidance right now using the timelines below, which you can see right down here. But the first thing I want to do is set the stage by remembering that the balance of your traditional IRA will be taxed at some point, either in your lifetime or within 10 years after your passing. That is a given. That it will be taxed is a given. So since the money being taxed is a given, then your job, if you want to minimize the tax burden on yourself and your family, is to figure out how to get as much of it as you can taxed at the lowest possible rates, while also remembering that there is no difference on your investment return or your after-tax cash flow between a Roth IRA and a traditional IRA if your tax rate is always the same. Let's do an example of this right now because this is a huge point of confusion for a lot of people. Okay, so here is the Roth versus traditional equivalence example, which I want you to understand. Let's assume for this example that at the end of 2024, you have $1 million in your traditional IRA. Now, the question I have for you is this: is it better to let this money grow pre-tax in the traditional IRA, or is it better to take that money and convert it over to Roth and let that money grow after tax in the Roth IRA? And people spend so much time thinking about and trying to figure out the right answer to that decision. And the answer is, pay attention now, the answer is these two things are equivalent as long as your tax rate stays the same. You can invest in the same underlying stocks, bonds, mutual funds in a traditional IRA as you can in a Roth IRA. So from the perspective of the underlying return, like the actual investments held in these vehicles, those two items are the same. And in this example, let's just assume a 5% annual rate of return. So pay attention to how the math works here. We have $1 million at the end of 2024. If I click on this cell right here, I'm taking the previous year's balance of $1 million and I'm multiplying it by 1 plus the growth rate, which again we said was 5%, to get a balance of $1,050,000 right here at the end of 2025. Then we're just going to continue the process for 2026, 2027, and for all years going all the way down to 2049 in this example. So let's summarize that. At the end of 2024, you have $1 million in a traditional. You're trying to decide, should I let it grow pre-tax until my retirement or RMD years, which in this case we'll just say is 2049. At that point, you would have a balance of $3.3 million pre-tax. And let's say that after that, you started taking distributions, whether they were in the form of RMDs or otherwise. And let's assume that all of the distributions are taxed at a 24% rate. So that's 3.3 million times 24% would be total tax on those distributions of $812,000. So we take the pre-tax balance of 3.3 million, we subtract off the 800,000, and the after-tax result in this situation is $2.57 million. Now, alternatively, your other decision could be, should I take that $1 million balance, convert it all to a Roth IRA now, pay the tax at 24% now, and if you did that, you would have 1 million times 24% is $240,000 in tax, and then 1 million, the pre-tax balance minus the tax paid on the conversion, would result in a balance at the end of 2024 in a Roth IRA of $760,000. Now, the same return on investment applies because you can invest in the same stocks, bonds, and mutual funds as we said within the Roth vehicle. So if I double click on this cell right here, this is again just taking the balance at the end of the previous year and multiplying it by 1 plus the rate of return. And so then we continue with that for 2026, 2027, and again all the way down here to 2049. And in 2049, which is going to be this row right here, what is the answer that's going to be right there? The after-tax amount of cash that you have access to in the Roth after the 25-year period. And the answer is $2.57 million, the exact same number that is right over here. What you should be taking away from this example right here is that the decision to be in a Roth or a traditional or to do conversions, all of it, the entire decision is just based on your tax rate, which will change over the course of your life as the facts and circumstances of your life change. For example, after retirement and when you're in the Roth IRA conversion sweet spot, you may have a lot of room in those lower brackets after retirement, pre-pension, pre-Social Security, pre-RMD, and that would be the perfect time, most likely, for you to get as much of this income as you can out of the traditional and put into the Roth at lower rates, because again, you are getting no additional benefit from pre-tax growth if your tax rate never changes. That is a very common misconception. That is an illusion that you are getting more if you grow pre-tax. You must unlearn what you have learned. You can see the numbers right here in front of you. You could grow the number at pre-tax and tax it at the end and end up with the exact same amount of money as if you tax it up front and then just let the money grow in a Roth after tax. The end result is the same. You do not end up with more after-tax money even though you were growing the money pre-tax. Again, the entire difference between these two account types is nothing more than a tax rate play. So if you want to end up with more after-tax cash throughout the course of your life, then what you need to do is find opportunities to convert this income out of a traditional IRA and into a Roth at the lowest rates possible to fill up those lower brackets when those lower brackets present themselves throughout the course of your life. You have the opportunity to keep thousands, even tens of thousands of dollars or more in after-tax cash in your family's pocketbook by identifying those years when you have room in those lower brackets to convert this money and get it taxed at the lowest rate possible, because again, it is going to be taxed no matter what, and it doesn't make any difference if you grow it pre-tax first and tax it at the end, or if you tax it first and then let it grow after tax. The only thing that matters is what rate is it actually getting taxed at. And all you have to do to accomplish that is lay out your numbers and figure out where your opportunities are. or don't. A lot of Americans don't. A lot of Americans don't do any tax planning at all. But one thing I can assure you, and I don't give you many guarantees on the channel, but I'll give you a guarantee on this. The IRS will never show up at your door and tell you that, you know what, buddy, you've been paying too much tax over the course of your life because you didn't take the time to sit down and simply figure out, where do I have room in the brackets in earlier years? And with that said, let's go back to our timelines and see where we may be able to identify those opportunities. All right, so first things first, we're going to start out over here on the right side of the chart in RMD territory. Remember, RMDs start at age 73 unless you were born in 1960 or later, and then they will start at age 75. So the question is, based on the value of your IRA today and what you estimate it may be once you arrive in RMD territory, what tax brackets is this additional RMD income going to put you into? Is it going to bump you up into the highest brackets? And when you're thinking about that, let's say you are married filing joint right now. You may only be thinking about this in terms of married filing joint. However, what is something out here that we must consider that could bump your tax up even higher? And the answer is widow's penalty down here. At some point out here in RMD territory, hopefully way far to the right off the screen where you can't see it, but at some point, most families will deal with the reality that one spouse is going to pass before the other. And in the year that one spouse passes, the surviving spouse will be in the qualifying widower filing status, but after that, they are going to be in the single filing status unless they remarry. And those single tax brackets are much lower. So now you are effectively dealing with the same amounts of RMD income, but in brackets that are about half the size of what they once were. So that's going to bump your tax up. And then, of course, remember, every single dollar in your IRA will be taxed in your lifetime or within 10 years of your passing. And if you pass a traditional IRA to your beneficiaries, then the money will be taxed in their brackets. If your beneficiaries are high earners and you have the opportunity now to accelerate the income through Roth conversions into lower brackets while you're still alive, but you choose not to and then just pass all the income in traditional IRA form, then all the remaining money inside of your traditional IRA will be taxed at their marginal rates. Now moving over here to the center of the chart, we have the Roth IRA conversion sweet spot. And remember, that is the time period between age 59 and a half and 73 when you can use funds coming out of the traditional IRA as part of the Roth conversion to cover the tax on the conversion without incurring any penalty. So within the Roth IRA conversion sweet spot, how are you going to identify those years when you have room in the lower brackets that could potentially absorb some of that income which you are shifting out of these potentially high income tax years? And the answer is, we're going to look at all of our other income items. So number one, a lot of people tend to retire somewhere in here, 59 and a half, 62, 65. There could be a number of years right here before Social Security has started, before you're on Medicare, when you may have the ability to push off the start date of pensions into the future, when you may be in a position where inherited IRAs haven't been received yet, so the RMDs related to those haven't started. If you want to visualize it using a picture, let's push Social Security out here into the future. Let's push the pension start dates out into the future. As I said, maybe inherited IRAs haven't started yet. Now all of a sudden the Roth conversion sweet spot, or what I might call the super sweet spot, is going to be like right about here, where there may be very little income in these years. That could be the perfect opportunity to grab some of this out of the traditional IRA, get it out of the RMD territory, and bring it back here into the lower brackets. This is what the personal tax planning template is designed to help you figure out. By laying out all of these facts and circumstances within the personal tax planning template, you will be able to identify where you have room in the lower brackets, how high in the brackets you will be out here in later years, and how much of this IRA income can you shift back here and get it taxed in the lower brackets. By the way, if you're new to my channel and you want to see the personal tax planning template in action, just search on YouTube for Number Crunch Nerds Roth IRA conversions. In that video series, you will find extensive demonstrations of what we just described here in this picture actually played out in action. So now, once you are done figuring all of this out within the personal tax planning template, what happens next? Well, now we bring it all the way back here to 2024. So now that we're back here, it's time to calculate what our projected taxable income for 2024 is going to look like. And once that is complete, we say, okay, how much room do we have left in whatever bracket is relevant to you, whichever one you may want to fill up. And then we grab some of this income that would potentially be over here in RMD territory, and through a Roth conversion, we bring it back to the current year. That is the Roth conversion smoothing strategy, accelerating income through Roth conversions to fill lower brackets now and avoid paying the tax potentially in higher brackets later, because we know from this example right over here, there is no after-tax difference in the amount of your investment based on whether you grow it pre-tax or after-tax. The only difference is the tax rate play. All you have to do is spend a couple of days per year thinking about this, and you can potentially save thousands, even tens of thousands of dollars in tax over the course of your life by doing some simple tax planning. You know, people always say to me, what is tax planning? What are you supposed to do? Well, it's very simple. You're supposed to understand the law and then understand how to fit your facts and circumstances within the boundaries of whatever the law is, or whatever it could realistically be expected to become. For example, take Social Security. This is one of the items that the incoming Trump administration is proposing to make a tax-free item. In other words, Social Security may no longer be subject to tax at any income level. Well, if that was the case, guess what? You could potentially have more incentive or more room to move some of this income out of RMD territory and put it back in here without risking the possibility that you could cause your Social Security to become taxable, assuming that it hadn't already reached maximum taxability already. Remember, under the current law, Social Security can be taxed up to 85%, just depending on your other income. Okay, so now we're back to 2024. Let's say that you laid out your 2024 income, you laid out all your future income up here in the personal tax planning template. You decided you have some room in the brackets, you decided to do a Roth IRA conversion. Well, then the next step after that is to determine by January 15th, 2025, if you need to make an estimated tax payment. So first you calculate your safe harbor payment. We went over this in video number 5 of this 2024 year-end tax planning series. We also went over in video 5 analyzing if the annualized income installment method election will help you, and it usually will if you do Roth IRA conversions in Q4 of any year. So once you determine what your safe harbor is and if you have enough in withholding from the conversion itself, or if you need to make an estimated tax payment, then you should remit your Q4 estimated payment, if there is one applicable, by January the 15th, 2025. Also starting that day, as I have mentioned before, is my 2024 tax prep class. We are going to do an extensive 2024 TurboTax walkthrough, including Form 1040 and most related forms and schedules. And we are going to incorporate 2025 law change analysis and planning strategies, because you know there are going to be a lot of changes coming under the new Trump administration with respect to tax law. So we are going to learn tax planning from inside the tax return. And we're also going to compare your 2024 actual results to your 2024 projection that you did right over here in the personal tax planning template. And we're going to determine, are you on track? Are you projecting appropriately, or are you way off? And if you are, what are you doing? We need to get you up to speed projecting your taxable income and your estimated tax appropriately, so that this entire process from up here projecting into the future to bringing the results down to the current year, to then taking that through the tax return and your annual filing, and make sure not only do you know what you're doing, but you are saving as much tax as you can and keeping as much after-tax cash flow in your family's pocketbook as you possibly can by understanding how to plan appropriately. As I said before, you have all the information and guidance you need from this series, plus the Roth IRA conversion video series on YouTube, to lay out a lifetime tax plan that has the potential to keep thousands, even tens of thousands of dollars of your hard-earned money in your family's pocketbook and out of the hands of the government. But how will you ever know what the right thing is to do unless you lay out your numbers and figure it out? So for folks interested, the personal tax planning template, along with extensive video-based instructional content, is available for purchase at the link in the description below this video. You will get lifetime access to the course, including all updates that I make to it as we continue to develop our tax planning strategies in 2025 and beyond. So that's going to be it for today's video. Thanks for watching, everybody, and I'll see you next time.